Good day, fellow traders and value investors, and welcome back to another episode in our series Start with the A's. Today we're diving into Alphabet, the company behind Search, YouTube, Android, Chrome, and of course Gemini AI. We're breaking down Google fundamentals, revenue drivers, intrinsic value, and whether the stock still offers long-term upside. Let's get into it. Alphabet is an American company headquartered in California. It is the third largest technology company by revenue after Amazon and Apple, the largest technology company by profit, and one of world's most valuable company. Alphabet operates through three major segments: Google Services, this segment currently brings most revenue; Google Cloud, the segment that grows at about 30% a year; and Other Bets, that includes Waymo, Verily, an experimental project, and this segment currently loses money but could become a billion-dollar business. In Q3 2025, Google reported 102 billion in revenue, that's up 16%, net income of 35 billion, up 33%, and diluted EPS of 287, up 35% year over year. And despite the 3.5 billion EU fine, margins remain strong. One concern I would have is the cost going up 19% to 71 billion, and that's because Google had to spend quite a bit for new data centers and on the AI infrastructure. Now the key part is what is driving Google's revenue. Google told us very clearly in the presentation and earnings call that the number one driver of revenue is AI expanded search usage. All evidence points to that, as 56 billion of revenue came from Google Search and other, and that's up 15% year over year. So as we can see, search is still 55% of Alphabet's total revenue, and AI is making search bigger, not replacing it. We'll have a look at the financials in trading view as well. I will skip the income statement as Google made it easy in the presentation. We'll turn straight to the balance sheet. We can see that Google has negative net debt, which means that they have more cash than debt. And if we expand and confirm that, we can see that they have 95 billion in cash and short-term investment, and the cash itself is 23 billion. Compared to debt of 28 billion, they can pretty much pay off their debt with the cash in hand. And then if we turn to the cash flow, we can see that year over year cash flow is growing, which is a positive. And then under statistic, we can see that Google is selling for a PE of 29.56, which is a bit higher than what I like it to see, but it's normal for a company the size of Google. Good margins, return on investment capital of 32% and growing year over year, and net margins of 35%, again growing year over year. Positive to see. And current ratio of 175, which is above my favorite number, my ideal number, and debt to equity below 0.11. We've seen that the debt is low. So low debt, high value for their assets, and a big pile of cash. Is it an undervalued stock or overvalued? We'll see in a little bit. We'll now look at the intrinsic value calculators based on the fundamentals. We will look at the Warren Buffett, Phil Town, and Peter Lynch's calculators. I used growth rate of 15%, EPS growth rate of 15%. When I was doing the research, I've seen the most conservative number of about 10% and more optimistic numbers at 20, 25, 30%. Over the last 5-10 years, Google managed to grow their EPS at a rate of about 20%. Will they be able to continue doing that? We don't know, and hence why I used a more conservative number of 15%. Based on this number, we can see that the Warren Buffett intrinsic value gives Google a value of $85 per share, which is way below what it sells at the minute. Phil Town returns a value of 159, which is half that of what is trading at the minute, and then Peter Lynch's returns undervalued score. So according to all three intrinsic value calculators based on the fundamentals, the stock is overvalued. We'll also look at my classic bear-based bull case scenarios, where I use the growth in advertisement as the key driver. In a bear case scenario, when ad growth slows, mild margin pressure from AI capex, we could see EPS growing to 10.8 in 5 years, for a PE multiple of 22 and a price target of about $237, which will be a lower price than what it sells at the minute. In a base case scenario with solid AI, ad growth, AI boosted engagement, cloud margins expand, we could see earnings per share growing to about $13.57, and the stock could be selling for a multiple of 27, PE multiple of 27, and we could value the stock at about $366 per share in 5 years. And then in a bull case scenario, strong ad pricing, AI meaningfully lifts monetization, cloud hyper growth. We could see earnings per share growing to 16.88 in 5 years, and the stock selling for a 32 PE multiple. And we could see the stock price at about $540 per share, which is just about 2 times higher than what it is at the minute. If we look at the probability scenario, we can see that the growth for bear case scenario will be minus 21, base 21, positive 21, 22%, and in the bull case scenario over 5 years the stock would grow 80%, which will give us a total 5 years return of 26%, making it a yearly of 473%. For me, this is way lower. I could get about this 4% yearly using a savings account, or I get this return on my uninvested cash in my with my broker. So it's overvalued. It's overvalued using my three calculator. It's overvalued using the 3 case scenarios and the probability weighted model. Looking at the risk factors, I've identified 4 bigger risks. First is regulatory fines and antitrust cases. Google just paid 3.5 billion to EU and more may come. Enormous capital expenditure, and we've seen earlier on Google is spending over 90 billion in 2025 alone to scale AI infrastructure. This can hurt the cash flow and this can continue going up. We'll see how AI bet will play out. Competition in AI and cloud, Microsoft, Meta, Amazon, all pushing aggressively. Monetization lag, AI usage is exploding, but monetization of AI search takes time. We'll see how much time. We'll see how that will be shown in the capital expenditure. We'll see how that will be shown in the revenue and net margins. Off to the charts now. If we'll zoom out, I drew 3 key support and resistance levels. The first bigger one was 150. Google came to it. It failed to pierce through and it dropped. And it dropped to its previous resistance level, and it used that level as support at around $85 per share. And then it came back to the 150 level again, and it managed to break it through on this occasion. It went through it, and then it came back and it used it as a support, and it used it as support on a couple of occasions. And then the next level was the 200. It came to it, it failed to pierce it through on the first attempt, and then on second attempt it broke through and it went through. I also opened a position in Google around this level. I aimed for a 2x and that successfully closed at about 270, I believe. So it was a profitable trade. I was developing my strategy, so I didn't aim for 3x at that time, but it would have worked as a 3x as well. What I noticed in my practice trading is that when a stock reaches a 3x, it might go slightly higher up, but then it finds some resistance and it goes sideways, and that resistance is due to some profit taking. So we'll have to watch the news, we'll have to watch the revenue, the earnings calls, and see how Google plays from there. But it's very possible that it'll find an additional resistance level, it'll come back down, and then it'll bounce off of it. 300 level might be a good candidate for support if the stock goes up, but it remains to be seen. So, what is the verdict? Google's growth engine is clear. AI is expanding search, not replacing it. Financially, the company is stronger than ever. EPS growth of 12 to 15% supports the long-term compounding. The probability-weighted model shows around 5% annual return over the next 5 years, with a possible double in price in a bull case scenario. So for me, at current price, Google looks fairly valued to slightly overvalued, depending on the assumption. If you're a long-term investor, Google still looks like one of the fastest, safest mega cap compounding machine in the market, but it is not a buy for me. If you enjoyed this breakdown, hit the like and let me know in the comments which stock you want me to analyze next on Fundamentals in Motion. Thanks for watching.